Welcome back. We have a GDP data release just in a few minutes here, but this morning we did also get updates from the ECB. We have the ECB leaving benchmark interest rates at 4.5%. This is that's their refinancing rate, marginal lending at 4.75, interest rate on deposit facility at 4. They decided to keep their interest rates unchanged at the European Central Bank. This is the first time we've seen that in about 10 months straight of hikes. ECB says that they intend to, let's see here. Hold on. We've got flexibility. This all has to do with their bond portfolio. Here we go. Is determined to ensure that inflation returns to 2%. We know that. We've heard that at the Federal Reserve as well. But they do expect that inflation is expected to stay high for potentially too long, and that's an interesting twist on the word or the phrase "higher for longer." Usually, we hear "higher for longer," we're thinking, "Oh, the Fed is telling us that rates are going to stay higher for longer." Here, you actually have the ECB suggesting that inflation is expected to stay too high for too long. So you have that impatience coming from actually the European Central Bank here when it comes to inflation. They did mention that inflation dropped markedly in September, including due to strong base effects. So just comparing year over year, they expect it to continue to fall as they continue on their data-driven approach. Sounds very familiar. Interest rate decisions will be based on an assessment of inflation outlook. Well, which right now is that they expect inflation to be high for too long. Interesting kind of twist on the higher for longer phrase. Now we've got GDP data release coming out within the next few minutes here. Remember, November 1 is the deadline for the 2023 HouseHack fundraise. Read the offering circular at househack.com. So we have the GDP report coming out in just a couple minutes now. GDP expected to come in at 4.5%. That's pretty hot. And we think that will give the Federal Reserve as much of a license as they want, so to speak, to reiterate that rates are not too high and that the Fed is appropriately aggressive. Of course, the stock market disagrees, and certainly you look at earnings that we've had over the last few days here, and people aren't extremely excited about earnings at the moment. So what we have here on inflation. Okay, let's see here. ECB rate hikes may be history, but widening QT is continuing. That's something else to remember is that even at the Fed in the United States, we could have an end to rate hikes, but you're still facing quantitative tightening to the level of which you haven't seen in a very, very long time. And so that's going to continue to take the vacuum cleaner to markets of cash, so to speak. I think that's the easiest way to think about it. You've got on one hand helicopter money, on the other hand, the vacuum cleaner. We're in the vacuum cleaner phase. Anyway, so that's a bit from the European Central Bank. Now we're on to third quarter GDP. We will get an inflation reading in the GDP numbers as well. Looking for a 2.5% rise at an annualized rate for core PCE figures. That is going to be on your quarter over quarter number and then annualized out to the year. So again, we're looking for, we actually got retail inventories and wholesale inventories coming out. Okay, let me read these off. This is a lot. We got 30 seconds to go here. So let's get buckled up for some of this data. Are you ready for this? It's a lot. Wholesale inventory is expected to be 0.1%. Retail inventory is 0.2%. GDP annualized 4.5%. Consumption is expected to be 4%. GDP price index 2.7. GDP PCE price index quarter over quarter 2.5%. Let's see. Here we go. So we're within about 10-ish seconds now of some of this wild data. Buckle up. We get a hot read here. It could be could push stocks down even more. Okay, well, wholesale inventories miss, coming at 0%. Retail inventories 0.9%, way up on retail inventories. There it is. GDP annualized beats. I expected that 2 days ago. We talked about 4.9%, way hotter than that, even that 4.5%. Yikes. Durable good orders come in at a beat, almost double for durable good orders at 4.7 versus 1.9%. GDP price index. Oh, thank goodness. The PCE price index comes in at just 2.4%. Now, the GDP non-core number comes in at 3.5. I wonder if that has to do with energy. Probably does. Durables ex transportation also come in with a beat at 0.5 versus 0.2%. Capital good orders come in at 0.6 versus the expected 0. And capital goods shipments come in flat versus the expected 0.2. You've got initial jobless claims coming in at 210,000, continuing claims at 1.79. Okay, so how do we parse this out? Well, it looks like less inflation here, stronger GDP, and retail inventory is really starting to back up a little bit. Let's listen to CNBC here break some of these numbers down, and I'll get us some more data as well.
Throw it back to you. It's a beat on the upside. We had seen a lot of forecasts out there for 5%, and I'll be digging in to see what the consumer did, see what business did. But you do have that inflation inside it, which was a percentage point higher than expected. Joe?
Yeah, consumer spending coming in on target. 4.9% annualized for the GDP. You know, this is very similar to what we saw with the everybody was making fun of it, but the Atlanta Fed real now GDP was really estimating that we were going to be somewhere around 5 to 6%. And it's kind of wild to think that, averaged out over the quarter and then annualized, they kind of weren't that far off. So you want to look at this one, GDP now. Just type into Google Atlanta GDP now. And this is the estimate for the Atlanta Fed of how strong GDP is right now. Whereas the blue line is the estimate of what the stock market thinks. Stock market really essentially feeling as though we're coming out of a recession. Anyway, let's keep listening here for a moment. I'll get some more data.
The U.S. jobless claims number up 10,000 to 210K. The week before, the October 14th week, jobless claims revised to 200K. Any quick thoughts on that?
Okay, no, it doesn't matter as much. But what matters is from the GDP release, the increase in real GDP reflected an increase in consumer spending, private inventory investment, exports, state and local government spending, federal government spending, and residential fixed investment that were partially offset by a decrease in non-residential fixed investment. Imports, which are subtracted in the calculation, increased. So here is the actual GDP release. This gives you the real GDP change from the prior quarter. This is very skewed, this sort of chart, because it shows you the insanity of the COVID quarter over here, and it makes all of this look really tiny on the right. But you can see here's sort of that recessionary time where we actually went negative in Q1, Q2 of 22. And now we're positive. You know, it's certainly not as positive as what we saw, at the end of last year or 2021. But compared to the first quarter, deceleration in real GDP in the second quarter was primarily due to a deceleration in consumer spending. Compared to the first quarter, this is from the second quarter, a downturn in exports. Okay, wait, so hold on a second. But this is today's release. Wait a sec. Is it though? Hold on. Let's make sure we have there we go. Okay, here we go. This is today's release. Advanced estimate. Okay, Q3. Perfect. All right. So this gives us our latest information. There we go. Look at that. Look at that little pop off on the right over there, showing you that strengthening GDP. Yet another push for the Federal Reserve. You know, if the Fed came out today and said, hey, flexible average inflation targeting, we're good with a number under 2.5%. You know, we'd basically already be there. Core PCE index on this GDP report coming in at 2.4%. You ready for this? This is the weakest reading since the end of 2020. Jeez, Lord. Let's take a look at some of the details of this actual GDP read. So here we go. This read reflects an increase in consumer spending, whereas the last month's read was a decline. But anyway, so an increase in consumer spending. Increase in consumer spending reflected both goods and services. Within services, the leading contributors were housing and utilities, healthcare, financial services, which, remember the last inflation report we got, financial services were taking off. Maybe that's because so many people are checking out HouseHack and reading the offering circular to invest in HouseHack. Deadline November 1st. Then we closed the fundraise for 23. Food services and accommodations. Within goods, the leading contributors to the increase were other non-durable goods led by prescription drugs, as well as recreational goods and vehicles. The increase in private inventory investment reflected increases in manufacturing and retail trade, while non-residential fixed investment, a decrease in equipment, was partially offset by IP spend. Compared to the second quarter, an acceleration in real GDP into the third quarter reflected accelerations in consumer spending, private inventory investment, and federal government spending. This is the part that we had read here. Now, I find it fascinating that at the same time as you have more consumer spend and private inventory investment, you're also seeing the government spend come through here. Remember, Inflation Reduction Act, support for solar, support for electric vehicles, support for chips and manufacturing. As much as that sort of spending might not be enough to prop up the disaster that is the stock market in some of these sectors, it is being supported here from a GDP point of view. Price index for gross domestic purchases, excuse me, up 3% compared with a 1.4% increase in the second quarter. That is your non-core figure. And then you have PCE, also now non-core, different measure, 2.9% compared to, with an increase of 2.5%. Excluding food and energy prices, here's your core, 2.4%, compared with 3.7% in the prior. That 2.4% is pretty good. We want to see all of that sort of start trending to that. Again, you get the Federal Reserve saying, all right, we'll just go with flexible average inflationary, a big change. The suits are saying, given the big slump in world trade, the U.S. must be one of a few advanced economies getting a lift from exports right now. You've got investment spending is pretty strong, contributing 1.47% to growth, the most since late 2014. The most since late 2014. Oh, sorry, late 2014. Where did I get this from? Late 2021. Sorry, when it was recovering from a contraction earlier that year because of COVID. Most of this is the buildup of inventories. It is, and then of course, non-residential fixed is flat. Personal consumption up 4% from last quarter. Big jump from only the 0.8% we got last time. Growth is coming from consumer spend, buildup in inventories. It's amazing how resilient the consumer has been. I wonder how the markets are responding to some of this data. Let's take a look here. So you've got, well, Tesla was down 2%. Now it's down like 1.3%. Look at that. What are these candles? I'm not familiar with green candles. What is this? You've got the NASDAQ here at trying to pull back up over its 348 level. You're at down about 0.6%, 350. You've got markets 2 years or 2-year treasury yields touching both session high and session low in the minutes after the data comes out. Now it looks like you're actually trending down 1 basis point on the 10-year. Okay, well, what's the 2-year doing? Let's take a look at the 2-year. 2 years down 2 basis points. Okay, all right. Well, there's your steepening of the yield curve again. That 10-2 inversion is what everybody's afraid of. It's sort of that reversion, I should say. We're only 16.2 percentage points in inverted, or basis points inverted right now. People are pretty nervous about what it means when we go positive under a Federal Reserve that is as aggressive as it is at making sure they've squeezed the last of the life out of inflation. It is, pretty clear that at least from, well, I guess the last inflation report wasn't as clear as it should have been, but the data report going into everything but this last September's report was pretty clear that inflation was fading away. Forward-looking inflation. Of course, the September report created a little bit of a mess. Here's your inverted yield curve, negative now 16 basis points. The zero line's right here. We are almost back to a normal yield curve. Can you imagine that? And that's a normal yield curve with the 10-year and the 2-year basically sitting at 5%. Just nuts. Okay, looking more at some of the numbers here from the suits. Retail inventories up 0.9%. That's a big move there in retail inventories. That's actually what you're seeing with companies like Enphase and Ubiquity, which are just absolutely getting destroyed in the stock market right now. These are phenomenal companies. They have at least some extent of pricing power. The problem is you're just manufacturing or able to manufacture so much more than what people are buying. So the consumer spend at least hasn't been in solar or potentially Ubic. And so now you have this buildup of inventory. And that's actually being reiterated here in the GDP report. Big increase in retail inventories, 0.9% versus the 0.2%. A lot of data coming through this morning. GDP, these GDP numbers are obviously pretty big, though. Given the big slump, okay, yeah, we talked about that. Household savings has been central to the part of the recession debate. Let's talk about the recession debate. According to today's release, it looks like personal savings have dipped. Personal savings came in at $776.9 billion in the third quarter, compared with $1.04 trillion in the second quarter. This morning, you've also got MasterCard reporting. Later, you'll have Amazon and Intel reporting. With a report from MasterCard this morning, it'll be very fascinating to see what MasterCard sees of the consumer. So when we look at American Express, pretty enthusiastic about the consumer at American Express. Again, more spending, more savings. But this is a wealthier cohort at American Express. MasterCard coming in with 3.39 on its adjusted EPS. The expectation was 3.23. So you actually have a beat. MasterCard beats on that EPS figure. Let's pull up MasterCard here. This is their earnings release a reaction. It's still down about 1.4% in the pre-market. Net revenue came in at 6.5 bill, a slight miss from the 6.53 expected. Citing macro geopolitical uncertainty, which is elevated. CEO sees a continued resilience in consumer spending. It's amazing. You know, when that stops, you've got real problems. And hopefully by then the Federal Reserve has backed off. But then again, 5-year break-even inflation rate sitting at 2.41. We go ahead and look at the 5-year forward break-even. And we pop in over here, 5-year forward, or sitting at about 2.48. So still expectations that inflation could be a something that takes a little bit longer in terms of time. So you've got Goldman Sachs responding, saying this number is unsurprising. Our expectations for slower GDP going forward are that some of the positive contributions from the volatile net exports and inventories are unlikely to be repeated. While this number makes the Fed weary of cutting rates, it does not move the needle for the November Fed FOMC meeting, which is certainly a skip. Higher and hold. Higher and hiking, no. That's your initial reaction from Goldman Sachs on the Federal Reserve. Keep in mind, nobody's really expecting the Fed to actually raise rates in November. The current estimates are that maybe we'll have a chance of seeing that in December. The chance of a November rate hike has actually fallen to just 8 basis points. We are at a 99.2% chance of no rate hike November 1st. However, we are at a 100% chance of the HouseHack fundraise coming to a close. We're going to have a renovation video coming out here very soon where you'll get to see one of our first renovations with HouseHack, which is really exciting. So you get to see some of that before and after and the speed at which it's being done, which is very exciting. November 13th is the next Fed meeting, and you're sitting at a 25% chance of one more rate hike, with January suggesting a cumulative 31% chance of another rate hike. March going then down to 26%. May almost pricing in a 34% chance of an interest rate cut. So a lot of uncertainty there, and the uncertainty leading to more stock market volatility. 10-year Treasury now down 2.8%. And third quarter PCE price came in softer, feeding into the soft landing narrative, making the fall in yields less surprising. Stock traders are unsure of how to trade this, as what the suits are saying, although it seems like stocks seem to be moving up on this. Boy, I'll tell you, the amount of volatility, though, that we've had here has been intense. Look at the drops on the NASDAQ. I mean, you look at a TA level here. We broke our yellow trend line, which has been a pretty supportive trend line. We broke the yellow trend line. We broke the 100-day moving average. We broke the sort of convergence pattern. Now the only thing we have holding us up is that 348 line. Other than that, we potentially drop to the 200-day moving average. So the NASDAQ here hopefully responding positively, which it will be nice to actually have a green day again in the stock market, but so far all red. So far 4.9% growth for last quarter, beat 52 out of 69 of the economists, just 17 thinking that we would actually have like a 5 handle number here. A lot of people, though, suggesting that this third quarter GDP number might not be that big of a deal. This is twice the pace of second quarter GDP. Remember that. We talked about that 2 days ago when I said warning about this GDP number coming. And that was that, we had a 2.1% rate increase in the last time around. Now we're sitting at 4.9%. This is just crazy. So who knows? But anyway, third quarter GDP here, very, very, very strong. Let's listen in here for a moment.
I do. The ADL Workplace Pledge is an easy way they can stand with their Jewish.
Okay, well, this is talking about, this is the ADL. Why do they keep airing this guy, the ADL, Anti-Twitter, Anti-Defamation League? It should just be the ADTL, the Anti-Twitter League. But anyway, all right, let's take a look here. The contribution from the federal government spending was a key driver of growth in the the third quarter. But given renewed political focus on debt, which with another deadline of the government shutdown due in November, that support may actually fade through 2024 and beyond. Overall prices rose closer to 3% last quarter, according to PCE non-core. A lot of this driven by energy prices. Consider what we have in oil. I mean, you pop on over to oil. You're at $88 for Brent right now. You are down 2.5% in the morning on Brent. You're not making it to that $100 barrel that everybody keeps warning about. It's like a lot of clickbait around $100 barrel oil. You can't even can't even keep it up above 90 right now on WTI. This also comes at the same time as Israel is actually, like yesterday, they're literally like, oh yeah, we have a ground incursion. The ground incursion is on hold as we're listening to the United States. Yeah, well, so much for listening to the United States. What do you have now? You literally have Israel starts ground incursion into Gaza. Now they're saying that this is a more limited ground incursion, and that this is just prep for potentially a larger incursion. And that they're training in what they've called Little Gaza, basically a little replica Palestinian village in southern Israel. While at the same time, though, Israeli tanks are now being cited as carrying out a raid into the Gaza Strip. This is being seen as the largest incursion into Gaza since October 7th. Soldiers located and struck numerous terror infrastructure and anti-tank missile launch posts and operated to prepare the battlefield. Troops left northern Gaza after the raid, so not occupying at the moment inside of the Gaza Strip, but they did incur. How would you say that? Incurred? They did conduct their incursion into the Gaza Strip this morning in sort of a more strategic, what looks like a brief incursion rather than invasion with occupation. Oh, those are a lot of big words. Invasion with occupation. Anyway, at the same time, you still have manhunt going on regarding the disaster that we got pounded with yesterday, which was when now 22 people are believed to be dead and 30 or now potentially 28 injured of the attack yesterday from a mass shooter in Maine. You have Sam Bankman-Fried expected to speak today at his Manhattan trial. U.S. economy, 4.9% third quarter. That's what we've been covering here. We've got, let me see what some of the other data is that we have coming in. Pending home sales coming in at 7. Again, continuing claims coming in at 210. And inventories being the big driver here. Suits telling us here's some more reaction. We continue to forecast an ongoing expansion and activity, but expect that pace to slow significantly in the fourth quarter as household spending slows. That's interesting. Like how many times have these suits been talking about household spending slowing? You've been hearing about household spending is going to slow. It's all going to come to a slow. We've been hearing about this over and over and over and over again. And we're just not really seeing it right now, this aggressive slowdown. We'll see. I mean, the fourth quarter is also your holiday spend time. It's your time for travel, snow travel, skiing. It's supposed to be the fun time with the family, all that. So we'll see what happens. Reminder, HouseHack's fundraise closes November 1st. And then we've also got the Noobverse Pro courses. We've got another price increase coming to those as we get ready to release the Noobverse Pro courses. They'll all be released before the end of the year, but we expect even before the end of the year, which isn't actually that far away. I mean, we're only 2 months away from the end of the year. How crazy is that? 2 months away from Christmas, folks. Wild. But do go to meetkevin.com to learn more about those Noobverse Pro courses. So I'm looking more at Wall Street's reaction here just to try to understand where Wall Street's heads are. You do have a volatile, response here on the Qs. As much as it's been up, it's been down in the last minutes. It's been up in the last minutes. Kind of wild. Tesla was down as much as 2% here. It's now sitting at about negative 1.6%. We've got services showing growth potentially due to Taylor Swift and Barbie. Yes, Taylor Swift and Barbie now being considered contributors here. Services were the bigger component of consumer spending, contributing 1.62 of the 4.9% growth. That is the strongest since the third quarter of 2021, with, quote, revenge spending after the reopening was the theme. Okay, this time around, in other words, after we had a reopening set of spend, now we have revenge spending. Okay, more revenge spending. Okay, whatever. Anyway, this time around, Taylor Swift concert effects, as well as Barbie and Oppenheimer movies, played a role in consumer service spending. Okay, wow. Anyway, thanks, T Swizzle. Going back to what Christine Lagarde is saying at the ECB, since she is speaking at the moment. Christine Lagarde giving us a breakdown. She says, okay, Lagarde, the economy remains weak. Manufacturing has continued to stall. We're pausing rate hikes, subdued demand, tighter financing to dampen consumption. Economy is likely to remain weak for the rest of the year. I guess they didn't have the Taylor Swift effect. Stresses the role of industry with its weakness spilling over to other sectors. However, inflation is declining. There are signs now that the labor market is weakening in the European markets. Okay, wow. So let's see here. ECB holds back rates after 10 consecutive hikes. Yeah, again, same thing with Europe. The question is, how long will they stay this high? Wild. Let's take a brief listen here for a moment. Oh, it's still how after the GDP figures? I really want to know this. How after the freaking GDP numbers is CNBC spending 10 minutes with the Anti-Defamation League loser? Oh my God. There's so much to cover here. Christine Lagarde, again, labor market. We've got that Ford UAW deal, which is on screen right here. 68% starting wage increase, 33% top wage increase, 25% wage increase overall, 11% immediate. Christine Lagarde, again, reiterating labor market. She stresses the role of industry with its weakness spilling over. We'll mention that. U.S. looking at ECB suit comments here. You've got quite a few more here. Hold on a sec. While we pick through the numbers, our colleagues in Europe are covering the ECB decision. We cover that. Okay, here we go. Investment in structures, factories, and warehouses has been partly fueled by the Bidenomics tax breaks that we saw. Yep, exactly. GDP numbers are already economic history. They're showing tailwinds going into 2024. Great question for how long this resilience will hold up. Business investment slipped 0.1% last quarter, the first decline in 2 years. Okay, so that's actually what I think is a potential risk to certainly stocks like Ubiquity, which I think they've already shown that in their pricing. But what you're finding is smaller businesses and medium businesses are the ones that aren't getting the big tax benefits from Bidenomics, as maybe the big businesses are. Your TSMCs to build its factories, your Tesla, whatever it might be. Ultimate goal of the Fed to rein in prices, so this report could be more comforting to them. That's the thing. Ultimately, if the economy grows while at the same time you have, inflation softening, that's a good thing. The figures show slower than anticipated acceleration in inflation, suggesting a softer number than the September CPI read we had. High inventory readings are perhaps the most worrying aspect. I don't see why that would be worrying, because really that's just going to cause more disinflation likely. Risks to growth to the downside. Christine Lagarde inflation expectations are elevated, but they need to be monitored more closely. Most measures of inflation for the long term currently stand around 2%. That's a way of treating this with flexible average readings. Right. Okay. It does look like the stock market continues to try to trend to the upside here, but that does give us a breakdown of what we're Salt chances. I literally replaced all my networking equipment with Ubiquiti last week. Oh, nice. Good for you. It is a phenomenal company. It's a great company. It's a great product. Obviously, economic times are taking their toll. Take a look at some of these other comments here. Oh, is Enphase reporting today? Really? Oh, okay. Well, I guess we're going drinking today. I thought the goal was not to drink anymore, but if Enphase is reporting today, I don't know is that true? I don't know if that's true. Enphase earnings release date. Oh, it is today, October 26th. Wow. I went to fact check you and you were right. Damn, after the market close. Oh, wow. Let's take a look at don't get me wrong, I still love the company. It's just it's like, wow, shoot. So earnings estimates for Enphase. Hopefully the estimates are just really low. So you're looking at $1 of EPS expected, revenue of $565 million. They've beat 7 out of 8 times on revenue, 8 out of 8 times on EPS. It's all going to be in that forecast, though, in terms of how the stock moves. You're looking at a potential 12% implied volatility on Enphase. Oh, if you get 12% to the downside, it's going to be like an $80 stock. Oh, that's crazy. Okay, anyway, today's numbers underscore the growing disconnect between a strong economy and sentiment. Opinion polls show that voters aren't crediting the Biden administration for the expanding economy and are instead focused on cost of living issues. Well, no duh. Everything's so much more freaking expensive than it used to be. God damn it. It's like a pisser. Intel reports earnings today, too. Everybody's spending money at AMC to see Taylor Swift. Yeah, going direct to AMC. I'm very curious to see how those numbers show up at AMC. Should be more money in it for AMC. So, but anyway, yeah, I mean, these are phenomenal. Honestly, like, let me just give you my just turn your computer upside down for the Enphase chart, right? Look, frankly, ignoring for a moment this whole, well, actually ignoring nothing for a moment, just being frank, these GDP numbers are goddamn awesome. They're great. The economy's doing fantastic. And inflation's coming in lower than expected for the forward reads. These are fantastic numbers. Interest rates don't need to be this high. Whatever. They obviously are. We've obviously overcorrected to, what used to be artificially low, now we're artificially high. Unfortunately, artificially low is much more enjoyable than artificially high. And right now we are at artificially high interest rates. And when the Federal Reserve might figure out that, I don't know. I'm going to tell you the projections for when the rate cuts are coming in just a moment. Let me quickly spam this here. Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized financial advice, nor is it real estate advice. It's not tax, legal, or otherwise personal advice. Get it? It's not personalized advice when we talk about this stuff. When I talk about stocks, myself or my actively managed fund could have positive positions in it. Any third-party content I show should not be endorsed by me, and this video is not reasonably sufficient information for the purposes of making investment decisions into any kind of stocks. There. I think I did that as fast as I could. All right, anyway, WIRP. This is the World Interest Rate Probability Curve, okay? I'm going to pull it up on screen. I want you to see it. Just because I read that doesn't mean we're done. We got more work to do, okay? The work doesn't end. Just because the market's red doesn't mean the work ends, damn it. All right. Study this, okay? Study this. Brandon Howard says, Kevin, how do you feel about a momentum push anytime soon? I would love that. Honestly, like, it's been a rough 3 months for everybody who's involved. I mean, unless you were short going into August, which, you know, you were probably getting burned at the beginning part of July if you were short and in the summer. But yeah, anyway, this is your world interest rate probability chart. Okay. It's called the WARP. Here's basically how it works. You take a little arrow so you can understand this a little bit better. Okay. We, friends, are right here. Okay. The market is anticipating that rates could go, here's the zero. The zero line is kind of like right there where these lines are. The market is still pricing in a slight chance of another rate increase. Now, here's the way to price this, okay? So 5.375 equals no more hikes, okay? To give you the exact number at the top of this, I will provide it to you in uno momento. Por favor. I don't know how to speak Spanish, okay? All right, line chart. I could speak German to you, but that doesn't do it. Oh, whoa. Oh, I haven't actually seen it drop like this. Whoa. Hold on a sec. So remember, 5.375 is the like sort of the peak level, right? That's where the market thinks no more rate hikes. You ready to see where it is? Check out the new Bruce Pro courses. Link below where the prices go up, and it's right here. Boom. 5.38. Holy crap. 5.38. Oh my gosh. That's crazy. You're basically saying no more rate hikes at all being priced in. Is this the right button?
Gain the lead.
Yeah. Holy smokes. Wow, I love hearing gain the lead. The downside is when when I go over here and then you go to like Tesla stock, it feels a lot more like
Lost the lead.
oh. Anyway, let's go back to the warp over here. All right. So we're basically, the market is sitting at 5.38, which is crazy. 5.38 market expectation. So you're basically saying no more rate hikes. Okay, that's not a surprise. The question now is, when do we cut and how far do we cut? Okay, well, here's December 18th. And the market right now thinks that by December 18th, we're going to go from 5.375 to about 4.75. So you're looking at about 60 bips of cuts by December of next year. By December 24. That's pretty weak. Like, I don't think Elon is going to be jumping up and down because the Fed's like, all right, boys and girls, the Fed cut rates 50, 60 bips. We're going to the moon. The weight of how long it's going to take is going to start hurting. You are at -4 basis points right now on the 10-year Treasury. I do want to mention that between now and Thanksgiving, we are recording a lot of the HouseHack videos, especially over the next week here as well. So if you want to learn more about those, that's financial advice from myself. Go to stackhack.com. It's actually licensed financial advice, stackhack.com. You can see all our links. You can just go to meetkevin.com if it's easier. New versus pro courses, HouseHack, StackHack. It's all there. It's kind of cool. So, okay, MasterCard. I want to see a little bit more on MasterCard here. MasterCard sees fourth quarter revenue growth low double digits. It looks like OpEx was at the high end. Net revenue growth low double digits. Looks like there's talk about an October slowdown for MasterCard consumer spending, suggesting even though there is continued resilience in the consumer, a potential slowdown coming. Let's take a listen. Okay, here we've got Biden warning Iran not to attack U.S. troops. Well, golly, I would hope he would say that. And then let's listen to CNBC for a brief moment here. What do we have here?
But this Mark Zuckerberg, he tends to want to know things, knows things that we want. Look at Reels.
Knows things that we want? Are you kidding me? Bro, the guy's talking about how with Meta, they made 1 billion avatars and how that's like great for their, AI technology or whatever. I think they have so much money. They have money coming out of every pore of their body at Meta. They don't know what the hell to do with artificial intelligence. I really don't. I don't see, if you really want real AI plays, it's NVIDIA, it's Tesla. Those are your real AI plays. To some extent, Microsoft, to some extent, although they have such a moat with their existing products anyway, Windows and the Windows suite. Google obviously for other aspects, but even their cloud growth missing, which isn't too exciting. But anyway, more reactions coming in here on GDP. American economy continues to exceed expectations. Reaction, bottom line is the staying power of growth spurt is questionable going forward. Well, they've been talking about the economy falling into recession for over a year now. And we did have a recession Q1, Q2 of 22. But the fact that everything keeps chugging along is just remarkable. But anyway, briefly listening here. Let's
The
go.
U.S., the hope is they'll come in somewhere around 12 and a half. That should be a positive. But the ad market's important for Amazon too.
Right.
So we may get yet another sort of read on that.
But, it's funny. Can I just analogize completely away from this, just so people don't get caught up and think we're just talking about tech? I'm very close to MasterCard, which is a really great company.
Yeah.
And our executive producer, Todd Bowen, was in my office when we were going over things. And out of nowhere, they report, and the number looks great. And I said, but told it the revenues look flat. Flat with what people are looking for.
I was going to say cross-border at MasterCard's up 21.
And I just said, throw that thing away. I found that, Nick. David, we'll probably talk later about the parent company of our network. And
I think we're going to actually have to talk now about the parent company of our network.
Why? Are you leaving?
Because the stock is down a lot.
Oh, no, don't take it so personally. It's not your fault.
It isn't.
I love that. Don't take it so personally. Okay, look. All I have to say is things suck right now. I totally believe that. However, I also believe that we're going to get through it. I know that optimism is so hard to believe when the stock market is acting so crappy. Hopefully things might actually go green today. Look, at least you're trending up. You were down 2% on Tesla. You're down 90 bips right now. You've got the Qs trying to stay above the 348 line. Short term, I know it's hard to feel optimism. I think really, when we look at the data, we say, wow, we should be so grateful that the consumer is even staying strong as we wait for inflation to really be convincingly low enough to where the Fed could say we're done. Once we're done, people could feel comfort in actually buying bonds without them actually getting wrecked. That lowers yields potentially more than the Fed lowers rates. Fed could lower rates 60 basis points, but if the 10-year Treasury yields roll over and people start locking in, these 4 to 5% yields for 20 years, 10, 20 years, then the yields fall very, very quickly. The more and more people start locking this in, and you could quickly get back towards a less uncertain market. Think about the uncertainties we still have left. Potential debt crisis here in a budget negotiation crisis in November. We just got a Speaker of the House, but we don't know how bills are going to move now. We have uncertainty with Israel. The government's supposed to be reining them in, but apparently now they're conducting their strikes, their incursion anyway. Although there was a limited operation they did overnight, and now it's expected they've pulled their raid back. You've got a manhunt going on in Maine. You've got more inflation in a softer economy in Europe. You've got a jobs market that still seems pretty tight. We're getting quite a few applications at jobs@meetkevin.com for the software team we're building out. We're doing interviews as well. So check that out at jobs@meetkevin.com. Really excited about that. Send us a video and a resume, but we're talking about our secret project. Anyway, so Yeah, I know it's hard to be optimistic in times like this, and I get that. And I would say, hey, you know what? Put the shield up, one foot in front of the other. Keep your head up. Keep working hard. But we're gonna get through this madness. So anyway, I appreciate you all being here. I'll keep bringing you news updates as I have them, and leave me some comments in terms of what kind of content you're looking for next.